Welcome, astute investors and curious minds, to the Income Strategy, your deep dive into the fascinating world of covered calls. Today, we're unlocking a powerful technique that can help you generate consistent income from your stock portfolio, even in volatile markets. We'll explore how this strategy works, why it's so popular, and how you can implement it effectively. So, if you're looking for ways to boost your returns and navigate the market with greater confidence, you're in the right place. Let's get started. Many of us invest in stocks with the hope of capital appreciation, buying low and selling high. And that's a fantastic goal. But what if we told you there's a way to earn income while you wait for that appreciation, or even when the market is moving sideways? That's precisely where the covered call strategy shines. It's an income-generating tool that can turn your existing stock holdings into a consistent cash flow machine. Think of it this way: you own a house. You hope its value goes up over time, right? But what if you could also rent out a spare room for a month or two, collecting rent while still owning the house and benefiting from its potential appreciation? That's a simplified analogy for what a covered call allows you to do with your stocks. You're essentially renting out the potential upside of your shares for a specific period in exchange for an upfront payment. Now let's break down the core components of a covered call. It involves two main elements. First, you need to own at least 100 shares of a particular stock. This is crucial. The term covered in covered call means you already own the underlying asset, the shares, that you're willing to potentially sell. This significantly reduces the risk compared to a naked call, where you don't own the shares and could face unlimited losses if the stock price skyrockets. We're all about smart, controlled strategies here. Second, you sell a call option against those 100 shares. A call option gives the buyer the right, but not the obligation, to purchase your shares at a predetermined price, called the strike price, on or before a specific date, the expiration date. In return for granting this right, the buyer pays you a premium, and that premium is your immediate, upfront income. Let's unpack that a bit further with an example. Imagine you own 100 shares of Innovate Corp. stock, which is currently trading at $50 per share. You believe Innovate Corp is a solid company, but you don't expect a massive surge in its price in the short term. You decide to sell a covered call. You might sell a call option with a strike price of $55 and an expiration date 1 month from now. For this option, you receive a premium of, say, $1.50 per share, which translates to $150 for the 100 shares, $1.50 x 100. This $150 is immediately yours regardless of what happens next. That's your income. So what are the potential outcomes when you sell this covered call? There are 3 main scenarios. Scenario 1. The stock price stays below the strike price, $55, at expiration. In this case, the call option expires worthless. The buyer of the option won't exercise their right to buy your shares at $55 because they can buy them for less in the open market. You get to keep your 100 shares of Innovate Corp, and you keep the $150 premium. You're free to sell another covered call on the same shares, continuing to generate income. This is often the ideal outcome for income generation. Scenario 2. The stock price rises above the strike price, $55, at expiration. If Innovate Corp jumps to, say, $58 per share, the buyer of the option will likely exercise their right to buy your shares at $55. Your 100 shares are called away from you at $55 each. While you do sell your shares, remember you still keep the $150 premium you received up front. So your total return includes the appreciation from your initial purchase price up to the strike price, plus the premium. You've essentially capped your upside at the strike price, but you've also guaranteed yourself a sale price and collected income. Scenario 3, the stock price drops. Let's say Innovate Corp falls to $45 per share. The call option still expires worthless because the strike price of $55 is well above the current market price. You keep your $150 premium. However, you still own the shares that have depreciated in value. The premium you received helps to offset some of those losses, effectively reducing your cost basis. This is an important point. Covered calls can mitigate losses, but they don't prevent them entirely if the underlying stock significantly declines. One of the greatest appeals of the covered call strategy is its versatility. It's not just for sideways markets. We can utilize it in different market environments to achieve various goals. In a relatively flat or slightly bullish market, covered calls are fantastic for consistent income generation. You can repeatedly sell calls, collect premiums, and continue to own your underlying shares. In a bearish or declining market, covered calls can help offset some of the potential losses on your stock holdings. The premium received acts as a buffer, reducing your overall cost basis and making the downturn a little less painful. Even in a strongly bullish market, covered calls can still be useful, though we need to be mindful of potentially capping our upside too early. If we expect a massive surge, we might choose a higher strike price or a shorter expiration period to allow for more capital appreciation. It's all about balancing income with potential growth. Now let's talk about the nuances and important considerations when implementing this strategy. It's not just about selling any call, it's about selling the right call for your goals. Choosing the right stock. Not all stocks are equally suited for covered calls. We generally look for stocks that we genuinely want to own long-term. Remember, you might be called away, so you should be comfortable owning the shares. Have relatively stable price movements. Highly volatile stocks can make covered calls more unpredictable. Offer decent option liquidity. This ensures there's an active market for the options you're selling, making it easier to get a fair price for your premium. Selecting the strike price. This is a critical decision. In the money, ITM calls. If the strike price is below the current stock price, you sell an ITM call. This generates a higher premium but also means your shares are more likely to be called away. You're effectively taking some of your unrealized gains up front. At the money, ATM calls. If the strike price is equal to the current stock price, you sell an ATM call. This offers a good balance of premium and the likelihood of being called away. Out of the money, OTM calls. If the strike price is above the current stock price, you sell an OTM call. This generates a lower premium, but your shares are less likely to be called away, allowing for more potential capital appreciation if the stock rises. We often favor OTM calls for pure income generation. Choosing the expiration date. The length of the option contract also impacts the premium. Short-term options, for example weekly or monthly. These typically offer lower premiums but allow for more frequent income generation and greater flexibility to adjust your strategy. Longer-term options, for example quarterly or longer. These generally offer higher premiums but tie up your shares for a longer period and reduce your flexibility. We often start with shorter-term options to gain experience and maximize our ability to roll or adjust our positions. Understanding time decay. Theta. This is your friend as a covered call seller. Options lose value as they get closer to expiration, all else being equal. This phenomenon is called time decay or theta. As a seller, you profit from this decay. The premium you receive at the outset is the maximum value of the option. As time passes, that value erodes, increasing the likelihood that the option expires worthless and you keep the full premium. If you're finding this information helpful and believe it's adding value to your investing toolkit, we encourage you to hit that like button and subscribe to our channel. Your support helps us create more content like this and reach a wider audience of aspiring and experienced investors. Let's delve deeper into some advanced tactics and common adjustments we can make with covered calls. Rolling the option. What happens if your stock is approaching the strike price and you don't want your shares to be called away? Or what if you want to extend your income stream? We can roll the option. Rolling up. We buy back the existing option, closing it, and sell a new option with a higher strike price, often for a later expiration date. This allows for more potential upside in the stock. Rolling out. We buy back the existing option and sell a new option with the same strike price, but a later expiration date. This extends the income stream and gives the stock more time to move. Rolling up and out. This is a combination where we buy back the existing option and sell a new option with both a higher strike price and a later expiration date. This is a common tactic to avoid assignment and generate additional premium. Rolling typically involves incurring a small debit cost to buy back the existing option, but the goal is to sell a new option for a larger credit, resulting in a net credit or at least a manageable debit for the overall transaction. Assignment risk and how to manage it. When the stock price goes above your strike price and stays there as expiration approaches, your shares are at risk of being assigned, meaning they will be called away. Letting it happen? Sometimes, assignment is exactly what we wanted. We sold the call because we were willing to part with the shares. Rolling the option. As discussed, rolling can defer or avoid assignment if we want to hold on to the shares. Buying back the call. If we absolutely do not want to sell our shares and the stock has soared past our strike price, we can simply buy back the call option. This will likely result in a loss on the option trade, but it allows us to retain our shares and capture all of the stock's appreciation. We generally do this only in extreme cases where the stock has significantly outperformed our expectations. Advantages of the covered call strategy. Generates consistent income. This is the primary benefit, turning your portfolio into a cash flow generator. Reduces cost basis. The premiums received effectively lower the average price you paid for your shares. Mitigates downside risk, partially. The premium acts as a buffer against moderate stock price declines, can enhance overall portfolio returns. Over time, the accumulated premiums can significantly boost your total returns. Relatively conservative. Compared to many other option strategies, covered calls are considered less risky because you own the underlying shares. Disadvantages and risks to consider. Caps upside potential. If the stock price skyrockets past your strike price, your shares will be called away, and you'll miss out on additional appreciation beyond the strike price. This is the trade-off for receiving the upfront premium. Still exposed to downside risk. While premiums help, a significant drop in the stock price will still result in losses on your shares. Commission costs. Each option trade, selling, buying back, rolling, incurs commission fees, which can eat into your profits if not managed carefully. Complexity. While not overly complex, it does require understanding options, terminology, and mechanics. Opportunity cost. The capital tied up in the 100 shares could potentially be used for other investments that might offer higher returns, though also potentially higher risk. Let's consider a scenario where we wouldn't want to use covered calls, or at least be very cautious. If we anticipate a major positive catalyst for a stock, say, an upcoming earnings report that we expect to be phenomenal, or a new product announcement that could send the stock soaring, then selling a covered call might not be the best move. In such a scenario, the potential for significant capital appreciation could far outweigh the premium we'd receive from selling a call. We'd risk having our shares called away just as they're about to make a huge move upward. It's all about aligning the strategy with our outlook for the underlying stock. Another crucial concept to grasp is implied volatility. This refers to the market's expectation of how much a stock's price will fluctuate in the future. High implied volatility generally means higher option premiums. This is because there's a greater perceived risk and potential for big price swings. Low implied volatility results in lower premiums. Savvy investors often look for opportunities to sell covered calls on stocks with high implied volatility to maximize the premium received. However, with that higher premium comes a higher chance of the stock making a sudden, unpredictable move, which could lead to assignment. It's a delicate balance. To wrap things up, the covered call strategy is a powerful and versatile tool that allows you to generate income from your existing stock holdings. It's not a magic bullet that eliminates risk, but it is a systematic approach to enhancing your portfolio's performance, especially in markets that are not experiencing explosive growth. By understanding the key concepts, owning the shares, selling the call, and managing the 3 potential outcomes, you can begin to incorporate this strategy into your own investment plan. It's all about being a proactive investor, not just a passive one. Covered calls give you the ability to take action and generate cash flow from assets you already own. So, we'd love to hear from you. What are your thoughts on the covered call strategy? Have you ever used it, or are you considering it for your portfolio? Share your experiences and questions in the comments below. We're here to learn and grow together. Thank you for joining us today, and we'll see you in the next video.